Progress. What is it? Out here, progress its numbers. Revenues made, profit generated, millions earned. But progress isn't just about growth. It's about the cost of growth. Destruction and creation go hand in hand. Every boom has its bust. Every rally its drop. In this game, if the price is right, I'm willing to ride out the chaos. The market will recover, but are you ready to take advantage of it? 1. Recap. First, let's talk about what happened last week and how it impacted the market. The S&P 500, NASDAQ, and Dow have all seen major drops. The NASDAQ is officially in bear market territory, down about 10% in just a week. This has largely been driven by escalating trade wars between the US and China. Tariffs have been ramped up, causing massive uncertainty in global trade. And when uncertainty hits, fear spreads, and the market reacts. Right now, we're seeing major volatility. In this fearful environment, emotions take over. Investors panic, and the VIX, a fear gauge, has spiked. People rush to sell off riskier assets and flood into safe havens like US Treasuries or gold. High-growth tech stocks get hammered as a result. This is where most people panic. They sell off their stocks thinking the worst is coming. But here's the truth. This isn't the first crisis we've faced, and it won't be the last. More videos will be made on this topic in the future. Make sure to subscribe so you do not miss them. 2. Trade war and historical context. Let's put things into perspective. The idea that trade wars or economic turmoil will destroy markets is more myth than fact. Take the 2018 to 2019 US-China trade war, for example. The market dropped sharply when tariffs were placed on hundreds of billions of dollars in goods. But within a year, the market had recovered, and the S&P 500 was hitting new highs. Even further back, during the Great Depression, the market lost nearly 90% of its value. But it recovered, slowly but surely. In the 2008 financial crisis, the S&P 500 fell by 57%. Yet by 2013, it was back to record highs. The COVID crash of 2020 saw a 30% drop, followed by a full recovery in months. So, yes, this isn't new. Every major downturn in history eventually led to a rebound. 3. This is just another crisis. So, what does that tell us? This is just another crisis in a long line of crises. Bear markets can last 6 to 18 months, but they always end. Volatility is part of the cycle. The market will recover. What separates the winners from the losers in this game is how you respond to the chaos. The natural human instinct is fear. When markets tank, panic sets in. We see everyone else selling, and we fear being left behind, missing out on the rebound. That's how the herd mentality works. You follow what everyone else is doing. But history shows that the panic-driven moves are almost always the wrong ones. When you stay calm and stick to your plan, you separate yourself from the crowd. You don't have to buy into every short-term fear. You need to trust that if you stay disciplined and keep your eye on the long term, you'll come out ahead. It's about controlling your emotions rather than letting your emotions control you. 4. The market always recovers. You've heard it before. The market always recovers. This isn't some pie-in-the-sky hope. We have historical proof. The global economy moves forward. Companies innovate. New businesses rise. Industries evolve. Take the 2008 financial crisis as an example. People thought it was the end of the financial world, but those who stayed invested bought at a discount and saw massive gains in the following years. Market doesn't crash and stay there. It rebounds. It always does. But here's the key. You need to stay disciplined and invest with a long-term mindset. Panic selling is the worst move you can make. 5. What should you do right now? Step 1. Stay calm. Don't let fear drive your decisions. Step 2. Avoid over-consuming financial news. The news thrives on drama. Headlines full of doom and gloom can distort your perception. Avoid constantly checking financial updates or listening to panic-driven commentators. The news doesn't have your long-term interests at heart. Stay focused on your strategy and filter out the noise. Step 3. Stick with dollar-cost averaging DCA. If you're using DCA, keep at it. This strategy helps you buy consistently, smoothing out the volatility, and ensures you're always invested. Step 4. If you have cash reserves, consider doubling down. If you have cash on hand and can afford to weather the storm, now could be a good time to double down on your DCA strategy. Buying during a market dip means you can get shares at a lower price, but only invest what you can afford to leave in the market for the long term. Step 5. Protect your personal finances. One of the biggest risks during market turmoil is forced asset sales. If you need to liquidate investments to cover personal expenses, that's a problem. Make sure you have an emergency fund and avoid excessive debt. Step 6. Increase your contributions. Focus on increasing your savings and investments. Whether it's adding more to retirement accounts, investing in side hustles, or growing your career, maximizing contributions during volatile periods is key. Forget about short-term returns. Your ability to contribute to the economy will drive long-term wealth. Step 7. Review your shopping list. Here's an important part of your strategy. Review the ETFs or companies you are considering buying. For companies, if their fundamentals are still solid, good revenue, manageable debt, strong management, this is a chance to buy them at a discount. Don't just buy cheap stocks because they've fallen. Look for quality companies that are temporarily undervalued. The goal is to buy into solid businesses that can thrive in tough markets. 6. Final takeaway. At the end of the day, this is just another cycle. There will be crashes, rebounds, and times of uncertainty. But if you stay calm, continue investing with strategies like DCA, and protect your personal finances, you'll be well positioned to not just survive, but thrive when the market recovers. Here's the thing. The market doesn't reward the panicked or the short-sighted. It rewards those who can stay calm, stick to their strategy, and keep looking toward the horizon. Think about your long-term financial future. The way forward isn't about catching every rally or avoiding every dip. It's about showing up day after day with consistency and a plan. So take a deep breath. Block out the panic-driven noise, trust the process, and keep moving forward. When the dust settles, it will be those who stayed disciplined who emerge ahead. Be industrious, brothers. Are you ready to join us on this journey? Are you ready to win? If you're enjoying this content, show some love, hit the like button, and give it a thumbs up.